Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Yes, it's headache time again. I must again apologize for the multitude of lines and labels that I've drawn on this daily chart. However, technically there's still a lot going on here, and these labels and lines are all valid in my deciphering and trying to decipher what is happening here. Okay, so instead of giving a huge history on this, I will instead talk about the action from the peak in April and reference earlier pieces as I deem necessary. The market's rise in April was up to the neckline of the August to November 2021 complex triple top, currently 2043. Breaching it, breaking it even, before the rally failed in mid-April, and we've seen prices drop after that, even gapping lower, until mid-May. Now, please keep in mind that neckline. Keep in mind that neckline of the August to November 2021 complex triple top as it pops up again later. Anyway, the massive congestion support around the middle line of December 2020, April 2021 bullish shift pitchfork currently at 1914. Mainly the combination of the February 2021 high at 1894, the medium moving average currently 1905, the long moving average currently 1914, and the short medium moving average currently 1924. Well, that eroded the bearishness on the way down from the start of May until the middle of the month, such that though prices pushed below all of those, the market did not have the energy or further impetus, shall we say, to aggressively push any further lower. For instance, below the congestion from February this year, between approximately 1840 and 18 even. Within this congestion, notably sits the 50% absolute Fibonacci line for the 21st century at 1809. Thus, on the 12th of May, the market made an immediate countering bullish engulfing pattern. That was the start of a strong, quick move higher, which halted a few days later on the 17th of May by our old friend, yes, it's the neckline of the August to November 2021 complex triple top, aided and abetted by an area of resistance that currently stretches from 2010 up to 21 even. This is not a new area. No. You can see a box to the upper left middle of the daily chart that I wrote. Well, I can't remember when I wrote it, but it details this specific band from January to February 2017. Visible just on this daily chart, this area has capped the market back in October and November 2021, and then again recently in April and May this year. All this action also created, some may say artificially, an island bottom over the first 2 weeks of May. The target for this island bottom was reached on the top side during the subsequent move higher. So, with all this action, where has that left us? Apart from confused and for a headache. Well, apart from the middle time of the big December 2020, April 21 bullish shift pitchfork, currently at 1914, there are two competing influences on this market. Because of so many lines drawn on this daily chart by me, last week I decided to do a first and color code them, green for bullish influence and red for bearish influence. This week I decided to make the relevant lines just a little bit wider for ease of viewing. Firstly, the bullish influence, and the one that has been broken and will be retired after this commentary, but it's worth talking about. It's the start of March to mid-May bullish shift pitchfork. To be honest, last week I said of this one, and I quote, "This one looks pretty weak and I wouldn't be surprised if it's retired next time." End of quote. Well, it will be retired. Next, the bearish influence, which is in red, and is the mid-April to mid-May bearish shift pitchfork, with the key times being the middle time overhead, currently at 1892, and the lower time below, currently 1794. The key levels below are the 21st century 50% absolute Fibonacci line at 1809 and the lower time. Now, one other thing that has happened this past week, with the pipe top formed over the weekend before last, and especially taking into account last Monday's shooting star type 1 pattern, a bearish pattern, we have seen created last week a weekly key reversal down. Additionally, today is very close to being a daily key reversal down, though it has pulled away from that. It's actually looking so we can have a daily key reversal up. So if we close tonight under 1837, or over, well, to be honest, 1838. If it goes over under 1837 or over 1840, then we're beyond. At the moment, it's looking just as if it might be a daily key reversal up. We'll have to see on that one. Ice Europe white sugar in London. Okay, so let's cover some of the groundwork. You see, this market has made a big meal from the break upwards out of the September 2021, February 2022 lopsided diamond pattern back in February. The move up took its own time, but by mid-April, the market reached up to the 572.20 area, the target for the mid-February, mid-April bullish halfway hesitation. Since then, we've had the changeover gap lower the market levels, and last month prices had pulled back to the vicinity of the congestion from early 2017 in the 517.80 area. This area is actually a complex support zone, as it also includes a neckline from the August to December 2021 complex head and shoulders top, currently at 529.30, as well as the important rising medium moving average, currently 535.10, and the rising long moving average, currently 520.10. This is why back in late April and early May, prices held over and around the 517.80 area, more or less, and under the old gap from March 2017 between 531.70 and 532.70. In mid-May, I posed the question, what does this period of intraday indecision, what does it signify? Does it signify a bottom, with prices moving back to the May 2017 high resistance at 548.70, or does it signify a halfway hesitation, with prices tripping down below all the moving averages, as well as the congestion area 488.10 to 490.10? The answer came during that same week when the market made a weekly key reversal up, which included a gapping move higher. After some stabilization over the March 2017 high of 548.70, the market started to be corralled on the top side for the most part by the middle time, currently 595.10, of the then newly drawn February to May bullish Andrews pitchfork. 5 weeks ago, the market made an unusual key reversal up on a prior bullish pattern that pushed prices up over the next resistance, which is the February 2017 high of 565 even, thus filling in the changeover gap. Now, 4 weeks ago, with another key reversal up, this time it was an immediate countering key reversal up and bullish engulfing pattern. The market pushed up over the next resistance level of 575 even, as well as the middle time and into banded resistances starting at 587.10, all the way up to 608.30, and including the November 2016 high of 590 even and the October 2016 high at 608.30. This congestion was too much for the bullish incentive, and 3 weeks ago the market made a weekly key reversal down in response. 2 weeks ago the market went through a period of indecision caught between roughly 555 even below and 570 above. Tuesday last week the market made up its mind and dropped down through the base of this congestion as well as the middle time, currently 564.40 of the newly drawn shallower bullish shift pitchfork for the same move as the bullish Andrews pitchfork. Prices then entered a fairly free zone below until late last week. The market entered an area with a combined congestion of the lower time of the bullish Andrews pitchfork, currently 549.70, the flatlining short medium moving average, currently 549.70, and the March 2017 high at 548.70. This support only lasted a day, and then Friday saw prices drop down through this towards the May gap, which is between 536.20 and 538 even. Today, apart from a short move higher to that previously mentioned congestion area, I assume to gather fresh ammunition for attacks on the downside, we've seen prices significantly lower. I suspect I'll be retiring the bullish Andrews pitchfork by next week. Last week now, I finished off my commentary by musing on whether the action over June was a version of a bearish halfway hesitation or a base building action. Well, this week it looks clear there is a bearish halfway hesitation type action. Hence, I've placed a potential target X in the 528 even area as a possible target for such a pattern. Yet there are things in the way before the market gets there. And I don't just mean the earlier mentioned gap. No. Rising from below, we have the medium moving average, currently 535.10. Then an old gap from March 2017 between 531.70 to 532.70 that may well still have some life in it. And then an interesting one, the neckline of the August to December 2021 complex head and shoulder stop. And that's currently at 529.30. And then, only then, would the market reach target X. Now that is quite some journey that way down. Sugar white premium spread. 2 weeks of consecutive indecisive spinning tops right at the top of the market led to last week's pattern, an unusual bearish engulfing pattern. This was after reaching target X recently at 162 even. 2 weeks ago, the market was still deciding what to do next, and last week it decided to head back down. The key pattern in recent times has been the eventually bullish ascending wedge pattern formed between June last year and March this year. The market had finally made sense of the false break higher, then lower, then back up from this ascending wedge pattern. It was a reasonable, good-looking pattern. I would not normally expect problems from such an action. However, problems are what started to happen. When prices reached the final part of the pattern, it's only the weekly key reversal up made 7 weeks ago that finally decided the matter. There have been a number of patterns and actions I've discussed here recently, but for now it seems we are left with only one. The 2019 to 2021 bullish Andrews pitchfork. The market's currently in between the middle time above, currently 139.25, and the lower time below, currently 65 even. Just below the middle time, we currently have the June 2020 high at 134.25. And then not much underneath until the short medium moving average, currently 128.25, which isn't that great at this time. Better support is below in the region of the lesser Fibonacci levels at 113 even and 115.5, plus the 2021 high at 116 even. We also have entering from below the rising medium moving average, currently 114.75. Meanwhile, looking above, beyond target X, we have a secondary, harder to achieve target X1 with the old ascending wedge pattern. Higher in the 191.5 area and off the top of my daily chart. Finally, I did the following a few weeks ago, and I quote, "I know that these are humongously big asks, but that is what I see. It depends on one thing and one thing only. The prices maintain contact with the middle time or break upwards clear of it." End of quote. Well, so far, prices have broken up through the middle time and seemingly consolidated, but are looking very, very suspect up here. We now wait and see what the market will make of the overhead congestion zone and if the harder to get target X1 is achievable. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.